Perfect. Well, good morning, everyone, and apologies about the slow start there. There's always some technical difficulties. My name is Liam Irwin. I'm a member of the client services team, and I'm joined today by Tamar Heffernan. Good morning, Tamar.
Good morning. Good morning, everybody.
Tamar is one of our team managers here at Kenor, and Tamar will offer you advice and support as we walk through the more commonly asked questions from new startups. So, just a little bit about Kenor. We are a member of Chartered Accountants Ireland. We are an award-winning accountancy and company secretarial practice for micro and small businesses and SMEs in Ireland and the UK. Most recently, we were awarded Zero Partner of the Year 2025 for 5 years running, as well as Online Practice of the Year at the Irish Accountancy Awards 2022 and 2024. So we aim to offer transparent fixed monthly pricing with offers for sole traders from €159 plus VAT per month and new startup companies from €159 plus VAT per month as well. So today's format, you can send in your questions as well during this webinar using the Q&A box. Please use the Q&A facility rather than the chat option, as this will ensure we do not miss any questions. There's a lot of content to cover in this webinar, so Tamara will answer the questions at the end if that's okay. And it's important to note the information contained in this webinar is for general information purposes only. For specific advice related to your business, you should always consult directly with an accountant. And if you don't have an accountant in place, we'd be more than happy to support you. So there's a lot of discussion points for today's webinar. The different business structures, limited company, sole trader, or partnership, the steps involved with setting up an Irish business, taxes for businesses in Ireland, such as corporation tax and VAT, annual compliance requirements with revenue and the CRO, and minimizing your tax liability. So we'll start with the business structures in Ireland. And how should I set up my business, sole trader, limited company, or partnership? So I guess I'll get Tamara just to tell me a little bit about the three options and what the key differences are between each of them.
Certainly. In Ireland, a sole trader, a partnership, and a limited company would be the main ways to set up and operate your business in Ireland. So firstly, I'll go through some details of a sole trader. So a sole trader would generally be the most simplistic way to set up and operate a business. And it's where one individual sets up and runs that business. A sole trader is only required to register with revenue for income tax, so compliance obligations tend to be slightly simpler than they would be for a limited company. Any profits you generate as a sole trader belong to you as an individual, so you'll be taxed on those profits under the self-assessment system, and that's income tax. As a sole trader is not a separate legal entity, a sole trader is personally liable for the debts of the business. So then we have a partnership, and this is very similar to a sole trader, but it's where two or more individuals come together and run that business. But again, it's not a separate legal entity. So with both a sole trader and a partnership, they are easy to set up, and if you need to, easy to shut down normally. A sole trader and a partnership would have slightly less filing obligations than a limited company would have. So I'll move on to limited companies. Company is a separate legal entity. So what that means is a standalone entity, and the creditors can only make a claim against the assets of the company. So personal assets are protected. So it gives a level of security. Any profits generated by the company belong to the company. So if you want to take money and funds out of the company, as a director, you'll be paid by a salary, or if you're a shareholder, be paid by a dividend. Corporation tax is paid on the profits belonging to a limited company, and companies can avail of the low corporation tax rate in Ireland, and we're going to discuss that in more detail later on in this webinar. As I mentioned before, there are slightly more filing obligations for a limited company than there would be for a sole trader or a partnership, and it can cost more to set up your limited company compared to that of a sole trader. In the event that you need to shut down a limited company, you must strike off the company with the Company Registration Office, and that can incur additional costs as well. So I suppose really in the long term, being set up as a limited company might be more tax efficient and can make you seem more established in the eyes of your clients, your suppliers, and your potential employees.
Thanks for that, Tamar. And it's good to know as well. We offer a number of packages to support you with setting your business up. Our company formation services are from €299 plus VAT. And for further information, please get in touch. You can contact us on client services at Canor for more info. So Tamara, which type of business would you, I guess, set up would you recommend?
Um, so it depends on a few things. It really depends on your personal circumstances and where you see your business going in, say, the next 2 or 5 to 10 years. If you are looking at starting a business which might have a low risk involved and has a level of turnover, so sales, which will just cover the business expenses and just covers the amount that you need for your personal income, and you might see your business staying small over the years, then setting up as a sole trader could be the best option for you. If the business might be generating a higher level of turnover, there could be a higher level of risk involved in your business activities, and you might have plans to grow your business, then you should consider setting up as a limited company, especially because this gives the protection of limited liability. Something else to consider is that if you are just starting out with your business, you may want to start as a sole trader and you could later consider changing to a limited company later on. The main reason for this is it is slightly easier and more cost efficient to close a sole trader business than in the event that you have to do that.
Perfect. And I guess, can you just walk us through the steps involved with setting up a limited company?
Yes, so to set up a limited company, you will need to register with the Company Registration Office, which is the CRO, to set up your company. And when you're doing this, you need to appoint and put in place at least one director and a company secretary. So the directors manage the company on behalf of its shareholders, and the company secretary makes sure your company is compliant with the CRO. And when you are setting up a business, to set up successfully, every director of a limited company is required to either have a PPSN, which is your personal public service number, or a VIF, which is a verified identity number. If you don't have a PPSN, you can get a VIF instead. So both the PPSN and the VIF are used by the CRO to verify your identity, and it protects against identity theft. You'll also need a registered address for the company. If you don't have an Irish address, which you can use for the company, you can use a registered address provider for that. You'll also need to appoint a leader. So what you're going to do there is decide to divide up the shares of your company and decide how much those shareholders will pay the company for the shares. And the shareholders are the people who ultimately own the company. And it's very common for directors to also be shareholders, especially in the early days of setting up your business. And finally, you'll need a company seal. So a company seal is used to stamp certain legal documents. And using that company seal on documents, it proves that the document is official and has been approved by the company and its directors.
It's brilliant information. And I guess if it's just me on my own, can I still set up a company?
Yes, you can. You can set up a company with one director and one company secretary. That can't be the same person. So if it is just you setting up your company on your own, what you can do is you could appoint yourself as director and you could use a company secretary service to appoint as the company secretary. If you're setting up a company and there's two directors involved in the company, then one of those can also be the company secretary. And you'd also need to have an EEA resident director in place. If you don't have one in place, what you'll have to do instead is you'll have to put a bond in place.
Okay. And I guess with the UK not being part of the EU anymore, if I'm the only director and UK resident, do I need to put a bond in place? And I suppose if so, when would that be?
Yes, you would. So where there's no director of the company who is going to be resident in the EEA, a non-residence director's bond should be put in place for the company, and that's put in place for a minimum term of 2 years. And what the bond does is it insures the company for a sum of up to €25,000. And the purpose of that bond is to ensure that the company completes all the required submissions and filings with revenue and the CRO. If you don't have that bond in place, your company would likely be in breach of Irish company law. So as a result, you'd be unable to file any of the company annual returns with the CRO until that's rectified. However, just to note, if one of the directors of your company is EEA resident, that bond is not required.
Brilliant. That's great to know. And I guess, can you explain what a share is, and is a share for both limited companies and sole traders?
Yeah, so with shares, they only apply to limited companies, so they don't apply to sole traders. Basically, company shares are pieces of your business. So the number of shares you have and you own determines how much of the company you own.
Okay. And what's the difference between authorized and issued shares?
So when you first set up your company in Ireland, the shares are broken down into those two categories. The authorized shares are the number of shares that a company can hold and can be issued at a future date. And the issued shares are the shares that have been issued to shareholders by the company. So I'll give an example. So for example, if a company had one shareholder and it issues 100 €1 shares to that individual, then that individual then owns 100% of the company. And that individual has to pay €100 to the company for the purchase of those shares. And for any funds that are paid to the company for shares, they can be used by the company to run the business.
Brilliant. That's great information there. And we'll just move across to business taxes. I know it's a hot topic for people setting up
Mhm.
new businesses. So can you tell our attendees a little bit about corporation tax and what taxes they can expect to pay as a limited company?
Yeah, absolutely. So, corporation tax is the tax paid on profits generated by a limited company. And there are two main corporation tax rates in Ireland. So there's the lower rate of 12.5%, and that rate applies to trading income generated from selling your goods or services. And there's the higher rate of 25%, which is for non-trading income. So this would be for income from, say, for example, rental income if the company that they're renting out, or another example would be investment income.
Thanks for that, Tamar. And I guess another lead on to that question will be, how can I qualify for the 12.5% rate?
So, not all Irish companies will automatically qualify for the lower rate of 12.5% for corporation tax. A company is considered tax resident in Ireland if it's managed and controlled in Ireland. So, if the company operates in another jurisdiction, for example, tax residency will depend on where the key decisions of the company are being made. So even if a company is not tax resident in Ireland, it must still pay tax on profits earned from business activities in Ireland. So, for example, maybe through a fixed office or through an agent, corporation tax will be due on those profits. If a company does operate in another country where there's a double taxation agreement with Ireland, the tax rules will depend on that agreement, usually meaning tax is paid where the work takes place. So it's really important to review a double taxation agreement and seek professional tax advice to ensure compliance if this is applicable to you. And basically, a double taxation agreement is a legal agreement between two countries, and it prevents individuals and companies from being taxed twice on their income. And I think we have a very helpful blog on our post about qualifying for corporation tax, the lower corporation tax rate. And I think we might share that with you in the chat a bit later on.
Perfect. Yeah, I can pop that in the chat. And I guess
Brilliant.
just as an example, if I live in France and I've decided to set up a company in Ireland, can I get the 12.5% rate?
Yeah, using that kind of example, if you were resident in France, you're running that business in France, you've no trade in Ireland, you've all business is basically being conducted in France, and you're making all of the key decisions of the company in France, then that company is most likely deemed as managed and controlled in France and not in Ireland. And this would mean that the company may have tax obligations in France as it can't demonstrate management and control in Ireland. And we always recommend that this type of company should speak to a tax advisor in France to discuss any tax obligations that arise there for the company.
Okay. And you mentioned managed and controlled in Ireland. Can you tell us what this means? Can I just fly into Dublin and make my decisions there?
Yeah, so if you were only, say, flying into Ireland once a year for, say, a meeting, this wouldn't be sufficient to demonstrate management and control, as it doesn't demonstrate a real presence in Ireland. So there's several factors that you need to consider if you're trying to establish if the company is managed and controlled in Ireland. And these are things such as number one, where do the majority of the directors reside? So, are there any Irish resident directors on the board of the company who are involved in the management and the running of the business? Number two is like, where are the important decisions of the company being made and where are company policies decided? Is that in Ireland or elsewhere? A third one is that where to consider where the board meetings held. Are they being held in Ireland? A fourth factor would be, does the company engage Irish-based employees to carry out the work of the company? And lastly, does the company have, say, a head office or a premises from which it operates in Ireland? So you really need to look at the whole picture.
It's brilliant. And we'll just move across to, I guess, registering for VAT. And I know it's a hugely popular topic. So does every company and sole trader have to register for VAT? And if so, when do they register for VAT?
Mm. So no, not every company and sole trader needs to register for VAT or even register straight away. There are many rules and some exceptions when it comes to VAT, but generally, if you have trading activity in Ireland and you are likely to exceed the thresholds for VAT registration, then you will need to register for VAT. So the thresholds for VAT registration are a turnover of 42,500 euro if you're supplying a service, and a turnover of 85,000 euro if you're selling goods. If you happen to supply both goods and services in your business, and if at least 90% of the turnover is from supplying goods, then the higher threshold of 85,000 euro applies. Otherwise, the lower threshold of 42,500 euro would apply. So as I mentioned, there are some exceptions to the general rules for VAT registration. One key example being when your business receives taxable services from outside of Ireland. So in that case, if that's applicable to you, you must register for VAT immediately, even if your turnover is below the usual thresholds that we just mentioned. You're required to self-account for the VAT on those expenses using what's known as the reverse charge mechanisms. So in other words, the normal VAT registration thresholds don't apply here. And the threshold is effectively zero for that situation.
Very good. And I guess, can you tell us a bit about VAT OSS and how does this impact businesses and how does the scheme work?
Yes, so VAT OS is the VAT one-stop shop scheme, and that applies to businesses that are selling B2C, so business to consumer goods or services cross-border in the EU. VAT OS doesn't apply to domestic Irish sales. And VAT OS was put in place to simplify VAT obligations for businesses who are selling goods and services to final consumers in the EU. And if this is applicable to your business, you would only need to register for a VAT number in one country rather than all of the EU countries where you are making sales. And it makes VAT declaration easier and quicker for a business. The threshold for VAT OS registration is a turnover of 10,000 euro for B2C cross-border sales to customers in other EU countries. And once you are registered for VAT OS, your business will apply the VAT rate applicable in the customer's EU state, so where the goods are being dispatched to or where the service is being supplied to. So you'll apply the customer's VAT rate to your sale. And for reporting obligations to revenue, VAT OS returns must be filed and liability paid on a quarterly basis.
So if I want to register for VAT right away, how can I do this?
You can also elect to register for VAT. So even if you've not, say, met the VAT registration thresholds, but it's really important to note that if you register for VAT because you are obliged by law to be VAT registered, there's no risk of a clawback of VAT. However, if there's no basis for your VAT registration and you've basically you've elected to register for VAT, then you have to bear in mind that if you do later deregister for VAT, a clawback of VAT could arise. And what happens here is revenue go back 3 years from the date that you cancel your VAT registration to calculate a clawback, so if you owe them any funds back. So any VAT which you recovered in excess of the VAT which you paid to revenue during that 3-year period will be clawed back by revenue, and that excess VAT would have to be repaid to revenue. And that's the last thing you want, especially if you happen to be maybe closing your business. So it is really important not to register for VAT lightly if you don't think that you will reach the thresholds for VAT registration, especially within your first year, or if you're not obliged to be registered for any other reason. So I would always recommend consulting with an accountant first before taking that step. And also, if you do choose to elect to register VAT to claim back VAT on your expenses, you will need to charge VAT on your sales from the date of registration. So you might want to consider how that might impact the competitiveness of your pricing before taking that step. You'll also be obligated to file bi-monthly VAT returns and the annual VAT return of trading details return, which can be an additional cost or burden to your business.
Thanks for that, Tamara. It's great information. Are there any scenarios where revenue might refuse to provide a VAT number?
Yes, revenue can refuse to provide a VAT number. So to register for VAT successfully, you will need to provide evidence to revenue that you have VATable activity in the state, so that you are actually trading in Ireland, and that you have an Irish trading address where the business activity is taking place. And they will ask for backup of that. If you are not providing VATable activity in the state, then you will need to consider if you are required to register for VAT in the countries where you are carrying out your trade.
Very good. Great. So we'll move across to compliance requirements for business owners. And I guess I know the CRO is the company's registration office. What responsibility do I have to the CRO?
So for a limited company, once the company has been incorporated, it will be assigned an ARD. So the ARD is the annual return date, and it's one of the most important dates for a company. The first annual return must be filed 6 months from the date of incorporation. So you file that with the CRO. The first annual return doesn't include any financial statements. It's just the annual return form, which gives the company's details. 12 months later, then the company must file the annual return along with its company financial statements, so its company accounts, and it must do that every year with the CRO. A limited company can also make company changes with the CRO. So, for example, if you wanted to maybe change a director, change director's address, change company secretary, or maybe change the company's registered address, you do that with the CRO.
That's great. And what if I miss the date and submit my documents late?
Yeah, so I suppose failing to file your company's annual return on time with the CRO can lead to some serious consequences. So firstly, a surcharge is applied immediately by the CRO, and that increases daily until the late return is submitted. And that goes up to a maximum penalty per return of €1,200. Secondly, the loss of audit exemption. So until recently, late filing meant an automatic loss of the audit exemption for the following 2 financial years, resulting in costly and time-consuming audits for companies. But new rules were introduced last year to ease the burden on small and micro companies. So what happens now is companies basically get a one-time grace period. So since July last year, small and micro companies will not automatically lose their audit exemption on the first occasion of filing an annual return late, provided it's the only late filing within a 5-year period. The audit exemption is then retained. So this means your company can file 1 late annual return in any 5-year window without triggering the 2-year audit requirement. However, the late fees still apply. So the surcharge that I mentioned a minute ago for late filing still remains in place. So I really recommend timely submission of your annual returns to avoid that. So what this change has done is it's offered a more proportionate approach to compliance, especially for smaller business. And for me personally, it's a welcome relief and pass. So I really encourage our clients just to stay vigilant with deadlines and avoid unnecessary costs and complications. Where a company has lost its right to the audit exemption, an audit would involve appointing a registered auditor to prepare and audit the company accounts prior to filing these with the CRO along with the annual return. And the cost of an audit can be a costly service. For I'll just go through some details of how you qualify for the audit exemption in the first place. So for small and micro companies to avail of an audit exemption, the company needs to satisfy some requirements. So a company needs to satisfy two or more of the following three requirements. So the first one is the turnover of the company does not exceed 15 million euro. The second one is the balance sheet total of the company does not exceed 7.5 million euro. And the third one is the average number of employees of the company does not exceed 50. So you can see there are a lot of small businesses fall into that criteria and they can avail of an audit exemption.
Absolutely. And it kind of highlights how important it is not to miss any deadlines to ensure you don't lose your audit exemption. Would that be fair to say, Tamara?
Yeah, absolutely. If you miss more than one annual return filing in a 5-year period, you risk losing your audit exemption. And it's for the following 2 years. So you have to have your accounts audited for the following 2 years. And this can be an unnecessary additional expense that can really vary based on the complexity of your business.
I suppose again, it highlights the importance of having an accountant in place to work with you on managing your deadlines, or, if there's at least have a company secretary that's familiar with all of your important filing requirements. Does a sole trader have to register with the CRO?
So no, the only time a sole trader needs to do anything with the CRO is if you want to trade under a different business name. If you're trading under your own name, you don't need to do that. But if you're trading under a different business name, you need to register that business name with the CRO.
Very good. Okay, that's good information. Um, and I guess, can you tell us what an RBO is and when should this be filed?
So the RBO is the registration of beneficial ownership filing. And what this is it's a mandatory filing um, which must be made within 5 months from the date of which your limited company has been incorporated. And what the RBO does is it outlines who ultimately owns the company. So if you were the sole shareholder, you'll be registering yourself as being the beneficial owner of the company on the RBO. Just to note as well, if you do wish to open a company bank account, the bank will normally require the RBO to be filed before allowing you to open a bank account. So that might be something you do want to consider filing as soon as the company's been incorporated so that you're prepared.
That's great, Tamar. Can you tell me, I guess it's a very important question I'm sure a lot of people have, is how do I report my taxes to revenue?
So within 3 months of incorporating your limited company, the company is required to either register for corporation tax or you need to notify revenue why you're not registering for corporation tax yet. So, for example, maybe you've not commenced a trade yet, and you do that by submitting a statement of particulars to revenue. It's just a one-page form. If you are registering for corporation tax, you'll need to file a TR2 form with revenue to register.
Okay, and when do I need to file my corporation tax return?
So a corporation tax return needs to be filed and paid every year, and it needs to be filed and paid every year within 9 months after the end of the company's accounting period. So, for example, say a company's year end was the 31st of December 2025, then that company needs to file its corporation tax return by the 23rd of September 2026. Preliminary corporation tax for the next year also needs to be paid by a limited company, and it needs to be paid each year 31 days before the end of the company's accounting period. So, for example, say the year end was the 31st of December 2025, that company is going to pay preliminary corporation tax for 2026, and they need to pay that by the 23rd of November 2026. For small companies whose corporation tax liability is not more than 200,000, you can base the amount of preliminary corporation tax that you're going to pay for a period on one of the following options. So you can choose to pay 100% of the corporation tax that you paid for the previous period. So you're basically paying the same amount again. Or you could choose to pay 90% of the corporation tax liability for that actual period if you can calculate that easily. And the amount that you pay for preliminary corporation tax shouldn't be less than the lower of those two options, or you could be charged interest if you do underpay it. So it's always safer to go with the first option, the 100%, if you're not sure. And finally, just to note, new and startup companies don't have to pay preliminary corporation tax for the very first accounting period if you have a corporation tax liability of less than €200,000. Instead, what you do is you pay your final corporation tax liability for the first accounting period when you're submitting your first corporation tax return.
That's great. There's a lot of information there, but I guess rest assured to all our attendees, there will be a copy of the recording sent to all of you, so you can definitely note them down after the webinar. But Tamara, a corporation tax return is for submitting the company's taxes. What about my personal taxes? How do I report these?
So, as a sole trader or as a proprietary director, you must register for income tax, and you do that by filing a TR1 form with Revenue. To register for income tax, you need to have a PPSN. A proprietary director is a director who owns 15% or more of the company's shares, and a proprietary director of an Irish company is an income tax return every year, in the same way that a sole. So this return, the income tax return, is due to be filed by the 31st of October of the following year. So, for example, the income tax return for 2025 is due to be filed by the 31st of October 2026. And Revenue usually give a slight extension if you're filing that online through Ross. This year, I think it's extended to the 18th of November. So even if you only had, say, employment income, or you had even no Irish income at all, as a proprietary director, you still need to file an income tax return.
And is this the same for a sole trader?
Yes, so as a sole trader, it's the same return. You need to file your income tax return, and you need to pay your income tax liability each year by the 31st of October of the following year, or by the extended deadline if you're filing online. But as a sole trader, you'll also have to pay preliminary income tax by the same date, the 31st of October. And basically, preliminary tax is an estimate of the income tax, PRSI, and universal social charge that you expect to pay for a tax year. And you need to make sure that you don't underpay your preliminary income tax, or you could be charged interest if you do happen to do that. Again, there's a couple of options on calculating the amount that you pay for your preliminary income tax, and it needs to be equal to or more than 100% of the income tax that you paid for the previous year, or 90% of the actual income tax due for that year.
Okay, so to confirm, Tamara, the deadline is the 31st of October for filing your return and paying your income tax liability as well as preliminary income tax. Can you file your return early? Is this good practice or advisable?
Yes, that's correct. So yes, you can file your income tax return early, and you can choose to schedule a direct debit if you wish of your income tax and preliminary income tax liability when you're filing that return early, or even schedule that direct debit earlier than that. The return usually becomes available with Revenue from around mid-January of the following year. And by doing this, this allows you time to plan and prepare for the amount of the liability that needs to be paid by the following October.
Brilliant. Okay, that's great information. And I know tax can be a scary topic for new businesses as well, so it's really important. But can you explain what a tax liability is?
So basically, a tax liability is the amount of tax which is due on profits. So for a sole trader, this would be income tax. And for a limited company, it's corporation tax.
Brilliant. And I've heard there are a lot of different tax credits available. How do I make sure that I've availed of all the tax credits that apply to
Mm.
me?
Yeah, there are many different personal tax credits available which will help you reduce your income tax liability. So, for example, there's a tax credit for certain medical expenses, such as doctor's visits and prescription charges. You can claim a tax credit for those. Another good example is the rent tax credit that came into effect in 2023. If you rent your home, you can claim a tax credit. So it's really important to speak to your accountant and let them know what your personal circumstances are so that they can help you to establish if you're entitled to any additional tax credits to help reduce your income tax liability.
Absolutely. And what's the best way to minimize my tax liability if I'm a sole trader or have a limited company?
So really for both limited companies and sole traders, you really need to ensure that you claim all allowable business costs and expenses. And to do that, you need to make sure you keep good records. So make sure you have invoices and receipts for all business expenses. If you trade as a limited company, the invoices issued to the company must be in the company's name and not in your personal name. Um, Taking a salary from a limited company will reduce the company's profits and therefore reduce the company's corporation tax liability. Another point to note is that a company can also contribute towards director's pension or even its employees' pensions as well. And that's a tax deductible expense and can help further reduce the company's tax liability.
Brilliant. And what is the difference between a business expense and a personal expense?
So business expenses, really for both limited companies and sole traders, would be largely similar. So any expense that is directly related to the running of your business, and so it's wholly and exclusively for the purpose of your business, should be an allowable business expense. So if you have an expense and you want to check, is this a business expense? Some key questions to ask yourself would be, is this expense wholly and exclusively for the purpose of my business? And is that expense necessary for you to carry out your trade? And would you have incurred that expense if it were not for the running of the business? So if you can answer yes to those, you should be able to claim the expense as a business expense. But if you are ever unsure, you should check with an accountant or with your accountant. I might just run through a few examples of what would be business expenses. So these are things like goods purchased for resale if you're selling goods, employee or director's wages, accountancy fees, rent rates and insurance costs, light and heat for the business premises, any legal and professional fees associated with the business. If you have subscription costs, those are also a business expense. Any travel costs, so just travel that's 100% for business purposes would be allowable. And finally, interest costs. Say maybe you've had to borrow money to finance your business, then the interest charged on that loan would be classed as a business expense.
Okay. And if you have a home office, can you claim heat, electricity, and internet? Or do the same rules apply here for sole trader and limited company?
Yeah, so some expenses like heat, electricity, internet can be used for both business and personal use. If maybe you've got a home office. So to claim these as a business expense, you will need to estimate the percentage that is used for business and then claim that portion as a business expense. You need to keep good record of this and of all expenses used for business purposes. And you need to be able to justify the percentage that you're claiming as well. And this applies for both sole traders and limited companies. What you do need to be careful with, though, would be fixed costs. So, for example, your broadband expense or a similar item to that. If that is a fixed monthly cost that you already had that doesn't increase because of the business, then it usually wouldn't be claimable as a business expense because you would have incurred that expense personally anyway, even if the business didn't exist. Um, and another thing is that if you have employees or directors who are required to work remotely, so they're working from home, the business can make payment of €3.20 per workday tax-free. And this is working from home allowance, or you may have heard it referred to as e-workers allowance as well. And that tax-free amount covers the employee's expenditure for light, heat, and internet. So if there are any employees who work from home and the employer isn't reimbursing them that set amount per day, what the employee can do instead is claim a tax credit on their tax return, and that's based on a percentage of the costs incurred for heat, light, and broadband for working from home.
And what about rent? Can this be claimed as well?
Yeah, you have to be careful with rent. So renting of an office space is an allowable expense for the business, but normally home rent is not allowable as that would be deemed a necessity for personal use. So what that means is, again, if the business didn't exist, you would have incurred that rent expense anyway. However, an argument could be potentially made to revenue if you have had to increase the size of your home to make space for the business. So, for example, maybe you had to move to a larger rented home that had an extra room for a home office or maybe for a storage space. You could claim a percentage of the rent as a business expense for that extra space. And it's really not advisable to claim rent as a business expense if you own your own home, as that could expose you to personal income tax on the rental income. And it can also cause some issues with capital gains tax if you later sell the property.
Brilliant information. Thanks for that, Tamara. And I guess we'll just move here to the next slide. So it's the again, an important topic for a lot of business owners. But how should I pay myself like a salary or dividends? And can
Mm.
you please advise, I guess, what the difference is between these two options?
Yes, absolutely. So, um, as a company director and shareholder, you can only take money from your company by way of a salary or a dividend, or it could be, say, a combination of salary and pension contributions. A salary and pension contributions are company expenses and they are tax deductible, whereas a dividend is not tax deductible to the company. A dividend is a payment to its shareholders from after-tax profits. And if a shareholder is resident in Ireland and is paying a dividend, the company must also deduct dividend withholding tax of 25% from that dividend and pay that tax to revenue along with filing a dividend withholding tax return. What happens then is the shareholder then gets a credit for that 25% tax that the company paid on their personal income tax return. And if you happen to be a non-resident shareholder, you can get an exemption from paying Irish dividend withholding tax. And that's done by completing a form V2A that's available on Revenue's website. And you complete that form prior to the company paying you a dividend. And then they don't have to deduct that tax.
Okay. And if I am a sole trader, how can I pay myself?
So with a sole trader, or as a sole trader, all the money your business earns is considered your personal income. So when you take money out of the business for personal reasons, it's personal reasons, it's often referred to as drawings. So for a sole trader, there's no formal payroll. What you do is you simply transfer money to yourself as needed. Um, and as a sole trader, you'll pay income tax on your total income after deducting all allowable business expenses, so on the profit. And that's done through your annual income tax return. Your sales, your as a sole trader happen to be over €5,000, you must register for income tax. However, if they're under €5,000, so your non-PAYE income is under €5,000, you don't actually have to register for income tax yet. What you can do is you can simply declare that on your Form 12, which you can file on Revenue's My Account. But once you go over the 5,000, you do need to register for income tax. And finally, one last point, just in terms of tax thresholds. So once your income goes above approximately €20,000 as a single individual, you will start paying income tax. And once it exceeds €13,000, so that's gross income, you will begin to start paying universal social charge. So because income tax return is only filed and paid once a year by the following October, it's really wise to set aside money on a regular basis. And that way you'll be prepared when your income tax bill becomes due.
Absolutely. It's again really good information there. Um, and that brings us to the end of um, the webinar. So thanks so much for that, Tamara. I'm sure there was a lot of insightful information. And again, we will send out a copy to all the attendees today. I will also put the link here to leave us a Google review if you felt this was useful. And there's a QR code which I'll leave up on the screen here for a couple of seconds to see if anyone would like to scan that. And then we'll run through some quick Q&A. I can see one is in here in the chat as well. So while people are still potentially scanning the QR code, I'll ask you here, Tamara. So what if I have Irish clients and the company's already set up? I'm flying all the time to Ireland to meet
Mm,
clients and sign contracts.
okay. Yeah, I mean, that would mean you meet some of the criteria, I suppose, taking into account management and control. Depending on where you're based, well, no, not depending on where you're based, I really would recommend, though, getting that tax advice, though, in your own jurisdiction at the start, just in case, just to make sure that you don't have any tax obligations where you are residing. I mean, if you are flying to Ireland all the time for both business purpose and meeting clients, signing contracts, and the business is taking place here, the double taxation agreement should have the right criteria where it means that your company is tax resident in Ireland. However, you should still get that tax advice in your own jurisdiction just to be 100% sure and just to make sure you're compliant in both jurisdictions and to protect you and the business.
Brilliant. And I guess there's another question here as well. So if I'm a single owner of a limited company, how do I decide the value of the shares, and I guess when must shares be paid, and how does that happen?
Yeah, I mean it's generally up to you, but generally we would recommend that you have 101 euro shares when you're starting out. So if you're the single shareholder, you're going to pay the company 100 euro for those shares at the start. Um, that would be the most simplistic way to set up, a company with one shareholder, one director.
Okay, brilliant. And I know this is probably a common question that gets asked. We have a lot of international clients sometimes. How do I put the bond in place for my new business?
You might be better to advise on that, Liam, being in the sales team. Our company secretary team take care of that, putting the bond in place. So I'm not actually involved in that in day to day. Apologies.
Yeah, I guess I can chime in there a bit as well. The company secretary team will look after it. They'll, get your KYC, so you know your customer, and verify all the identity, and then they take care of the full process there through the CRO as well once that's purchased. And again,
Thanks,
we'll
Liam.
have more information on the website for that as well. So that's all the questions there. There's also our contact details here as well. So you can give us a call anytime if you're looking for an accountant or just looking for company formation services. And our email address there is clientservices@canor.com. And we have a live chat support on the website as well.